Welcome. In this video, can ZBCN coin holders get rich? We will analyze this. Don't forget to subscribe and like, and please watch to the end to understand. One of the important building blocks on the chart is a strong bullish order block located just below the current price level. In the past, this area has been characterized as a level where the price encountered a significant buying reaction and buyers entered the market strongly. In technical analysis, such areas are known as places where institutional investors or big players are actively buying. This point, where the price has previously turned sharply upwards, has a high potential to produce a similar reaction if it is retested. Order blocks are among the important structures that determine the direction of the price and are considered as the starting points of the turns. If we are talking about a particularly bullish order block, this zone often represents an area where aggressive buy orders accumulate. Market participants have already made high-volume purchases here, indicating that there is a strong demand below the relevant level. This demand level can work as a support in case the price falls and limit the declines. The current chart shows that the price is in a retracement towards this bullish order block zone. While this may seem like a sign of risk to some traders, technically, such pullbacks are considered a healthy corrective move. Because occasional pullbacks in every uptrend both reduce the overbought pressure in the market and provide an opportunity for new investors to enter. A possible pullback towards the bullish order block can also be a strategic opportunity for buyers to re-engage. Traders often see such areas as liquidity pools. Liquidity areas are considered strategic areas where large traders use to restructure their positions, make volume purchases, and re-enter the market. In this context, if the price approaches this order block zone, it could set the stage for a bullish reignition. In addition, a look at past price action shows that this level has been tested multiple times, with sharp rallies following each test. This proves that this area is more than just a support level. Buyer pressure here makes it difficult for sellers to gain the upper hand and sets the stage for the price to bounce upwards every time. In technical analysis, areas where the price has previously reacted strongly are called reaction zones. These areas often leave a mark in traders' memories. Therefore, when the price comes back to the same area, similar behavior is likely to be repeated. In line with this technical principle, it would be a logical and expected scenario that if the price approaches this bullish order block again, it will face a buying reaction as it has in the past. Also, any patterns that may form around this order block area should be closely monitored. Candlestick patterns such as a doji, hammer, or bullish engulfing pattern that may form during the contact with this area may give strong signals that buying pressure has come into play and the uptrend may begin. The increase in volume that comes with such candle signals may also indicate that the bullish move is not just a short-term reaction, but a harbinger of a more permanent move. Another important detail is how much volume is involved in the decline towards this level. If the price reaches this level on low volume, it suggests that the decline is coming with weak momentum and the bull order block will not be easily broken. But if there is a high volume and aggressive decline, then the strength of this zone can be tested. But in the current structure, it seems that the price is coming to this level on a calm and measured retracement. This raises the possibility that the bull order block will be defended again, and the price will generate a reaction from here. A strategic approach for traders would be to wait for a retest of this level and take a position according to the bullish signals that may occur here. But we cannot decide the analysis only with the order block. Let's look at other metrics. Keep watching. One of the most important technical elements of the chart is the Fibonacci retracement levels between the recent bottom and the peak. Fibonacci retracement tools in particular are a very effective way to identify possible reversal levels in the markets in advance and to see where the price can find support. One of the critical ratios offered by this analysis tool, 0,618, followed by 0,786, are often known as areas where the price reacts strongly and changes direction. As a result of the recent bearish movement, investors' attention is focused on these two important levels. Because when the price reached the area between the ratios of 0,618 and 0,786 according to the Fibonacci measurement drawn from the bottom to the top, it exhibited a significant slowdown and its downward momentum began to decrease. 0.618 is considered one of the places where the price can naturally find support based on the principle of the golden ratio, which is seen in many ratios in nature. 0.786, although it implies a deeper correction, usually acts as the last line of support, and upward reversals from there are often observed. In the current situation, the price has started an upward reaction move from the intersection of these two levels. This shows us that market participants may have considered this area as a buying opportunity. In technical terms, this area worked as a demand zone, and the previous selling pressure started to decrease in this region. This new momentum, with buyers stepping in, seems to have set the stage for the price to start an upward journey again. Many professional traders and technical analysts have repeatedly observed that price action rebounds after such Fibonacci levels, and new highs are targeted. Therefore, it is an extremely likely scenario that the price will accelerate upwards from the current levels and start retesting the previous highs. Especially if this turn is supported by volume, it is technically expected that the price will make a serious upward attack and reach the previous highs. In addition, the upward movement of the price from this region also indicates that bullish sentiment in the market is regaining confidence and the buy side is gaining weight. This usually creates a psychologically positive mood as well. This is because the reactions from the Fibonacci 0,618 and 0,786 levels have been the starting points of rallies many times in the past. This technical data is an important reference point for traders' position opening decisions. Since the price is currently reacting from this area, it may have attracted the attention of both short-term and medium-term traders. After such a move, traders should also pay attention to what obstacles the price may face on its way to the top. First of all, the previous high will work as a technical resistance zone. When the price hits this level, some profit realizations may be seen. However, the price reversal from these levels is not only a technical phenomenon, but also a behavior that reflects the general psychology of the market. This is because many traders see the Fibonacci 0,618 and 0,786 levels as buying opportunities and tend to take positions in these areas. This collective behavior increases the intensity of demand and contributes to the upward movement of the price. This is why technical analysis is not just about chart plots, but also the art of predicting mass behavior. Looking at the chart from a broader perspective, it is clear that the price action has recently undergone a significant structural transformation. In particular, the pricing above the 200 EMA is one of the first and most obvious signals of this transformation. The 200 EMA is not only an average in technical analysis, but also a strong indicator that reveals the directional trend of the market. Pricing above the 200 EMA is a critical signal, especially for large investors, institutional buyers, and long-term position holders. This is because these players usually trade less frequently, but the duration of their positions is long and their trading volumes are large. Therefore, their re-entry may result in a steady and sustainable uptrend. Traders who hold their positions, are patient, and time their purchases correctly can make significant gains. Moreover, this technical outlook can turn into a much more solid bullish backdrop if it is supported not only from a graphical perspective, but also from a fundamental analysis framework. In such a scenario, not only small-scale rallies, but also medium and large-scale rallies. This could lead to significant increases in the value of the portfolios of investors who took early positions. As a result, when the price starts to break above the 200-day exponential moving average, it could be a sign that the market has changed direction and is at the beginning of a strong uptrend. This technical development could create significant opportunities for investors who patiently hold their positions. If this pattern continues and the price continues to hold above this level, it is possible to talk about a serious bullish potential in the coming period. And this uptrend may not only be a short-term bounce, but also part of a larger trend that could provide investors with significant gains in the medium and long term. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.